With world-class expertise and local insight, Dexus creates value not just for today, but long into tomorrow.
From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hi there, welcome to the COB. I'm Nadine Blaney. It's an absolute pleasure to be here with you on RBA Day, Rates Day. So you would have heard Michele Bullock, the RBA Governor, speaking just a short time ago when she was asked about housing prices in relation to cutting rates. She was quite clear in saying that other policy measures needed to be utilized, that is not the primary role of the RBA. All right, so that is the backdrop for this market performance today. We could actually see a little bit of trepidation heading into that interest rate cut, 25 basis points coming through from the RBA as widely expected, but picking up a little bit steam in toward the close. That's the CBO Australia Index, which is done and dusted for the day, up by 0.7, close to 0.8%. The S&P ASX 200 at 8,343, up by 0.6%. I am noting that U.S. futures are lower at this time of the day. Just past 4:10 p.m. here in Sydney. So that was a pretty clear cut coming from the RBA. I'll get some thoughts from Julia Lee, who is standing by. And we are also watching the opposite reaction coming through when it comes to the Aussie dollar taking a big dive. But yeah, the market looking pretty sweet right now. So let's get right to it, shall we, across some of the sectors of the day, and taking a look at some of the big sectors. The banks doing quite well. ANZ up by 1.5%. Commonwealth Bank putting on 0.7% to $171.99. Now, some of those interest rate sensitive areas of the market, that being REITs looking pretty sharp. Goodman Group up by 2% to $32.92, I think that was. And yeah, some of those other REITs looking good as well on your screen. Healthcare space, we've got CSL making some good gains, up by more than 1%. Ansell as well as Sonic Healthcare, so outperforming the broader index. And into the tech space, WiseTech Global up by 3%. TechnologyOne reported today, upgraded its guidance, up by 12% to $36.90. We learned today that Rio Tinto will be partnering with Chile's Codelco to develop and operate a high-grade lithium project in Chile. Worley is reaffirming its outlook. It's expecting to deliver low-digit earnings growth, and I think it's low double-digit earnings growth and underlying earnings margins between 8 and 8.5% in FY25. Regis Resources says it's confident in the ongoing potential for further growth and life extension at its underground mines. And Kogan says that its Mighty 8 platform continued to be impacted by tech challenges, and it also updated in its business update some of its metrics around sales and earnings. Breville is facing tariff headwinds, according to Morgan Stanley. Telstra has lifted as it plans to hike prices, up by 2.3% to $4.66. But ResMed slipped after one of its rivals, actually an unlisted company, posted positive clinical trial results. And Monash IVF has downgraded its guidance from an underlying profit after tax of $30 million to $27.5 million. But I would like to focus on the bigger picture, and welcome to the COB for that, Julia Lee from FTSE Russell. Julia, welcome. I know you were listening in to a bit of what the Reserve Bank Governor Michele Bullock had to say. What is your takeaway from this hike that we saw?
First of all, the interest rate decision bang in on expectations with a 25 basis point cut down to 3.85%. And it's also interesting having a look at where the interest rate market is predicting that interest rates will be by the end of the year, and that's further downwards at 3.2%. I think one of the big things we were watching for were comments around the labour market, given the very strong jobs numbers that we saw this week, not only on the wages front, but also in terms of jobs growth. So it's interesting that in its quarterly, we've seen the RBA upgrading its forecast for the unemployment rate from 4.1% to 4.3% to year end. Previously, it had been forecasting 4.2%, so a slight rise there. Of course, we're also looking at government spending, and fiscal spending is expected still to be quite stimulatory if you have a look at the planning and watching those inflation expectations, even though we have seen inflation and that trend coming back down to a much more comfortable level. But all in all, if we have a look across the market, there were a lot of impacts to be watching on the market today. The Aussie share market, though, finishing up 0.6%. And in particular, just watching that real estate market, which seemed to get an extra uplift after that interest rate cut. And of course, real estate is one of those areas which are relatively highly geared. So seeing those funding costs coming down are positive for that sector.
Certainly. So that is Australia. Were you surprised that there wasn't sort of a little bit more baked into the market, the equity market reaction, or is it just because it was so widely telegraphed that this was likely to be the case?
I think it was widely expected, but there was also going on a lot behind the scenes when it comes to the Asian session and markets today. First of all, we also saw rate cuts coming through from China. And if we have a look, China's really been on this stimulatory path since September last year. These are the first rate cuts, though, that we've seen since October last year. We've seen liquidity injections, and now we've seen rate cuts to both the 1 year as well as the 5 year by 10 basis points. Of course, it does come as industrial production has been relatively soft, and fears that the tariff environment is doing some damage to growth rates over there. So seeing those rate cuts come through, we were in particular watching that material space, but there didn't seem to be a huge impact coming through there. And I guess if we have a look at investments going into China, although we've seen that lower economic growth coming through in 2025, it doesn't actually represent Chinese investments. If we have a look at the iShares China large caps, that's actually up 15% in the year to date. And I think we have seen stimulus expectations really stirring up some positive sentiment around China. At some stage, though, markets will demand that you do see some of the hard data starting to improve as well. So there's only so long that really the market can run on fumes and sentiment as well as stimulus. And we really want to see some of those more positive growth numbers starting to come through.
Okay, so that is Australia, that is China. And then we look to, I guess, longer term yields as well. So important right now. We had that downgrade of the US credit rating, no big surprise. But what are the longer term dated yields telling us about the economy going forward, Julia?
Wow, it's been quite a ride for long-term treasuries as well as the JGBs. So if we have a look at US longer-term yields as well as Japanese yields, there's been some pretty big moves over the last 24, 48 hours. Now, the US moves not wholly unanticipated, given that we've seen Moody's downgrading US debt, and that's the last out of the big three ratings agencies to downgrade on US debt. But of course, there is a large pile of US debt, and this is one of the concerns of the market. At the end of last year, we saw, US debt at 130% of GDP. But not only are we seeing yields move in terms of the US 10-year treasuries, but also Japanese yields have been moving very quickly as well. And this is a concern because Japan also has a lot of debt on its books. But not only that, Japanese investors are pretty large holders of US treasuries as well. So watching the bond market at the moment does look like those longer-term funding costs are rising, and that could be a headwind in terms of global economic growth, but certainly some pretty wild moves overnight.
Yeah, okay. We will continue to watch that with much interest. We saw pressure coming through on the Aussie in the wake of that interest rate cut, but we've also seen some pressure on the US dollar. Is that expected to continue?
I think the US dollar is an unusual one. Earlier this year, we saw sort of the US dollar selling off because of the volatility, but now it seems more of a prolonged move where investors are happier to really downweight some of their holdings in terms of the US currency to be underweight. And I guess selling of those that US currency comes from selling of US assets, where that idea of US exceptionalism, that US economic growth would outshine the rest of the world, well, that view probably has seen a peak. So the US currency has been under a fair bit of pressure. We have a look at the implications of that weaker US currency. We know that a lot of Australian investors invest overseas, and when they're invested in the US, they really want to see the US currency rising while they're invested to help their investment returns. So the weakness in the US currency isn't helping Australian investors in terms of their overseas investments right now, but of course also an impact in terms of the US consumer, where goods from around the world generally become more expensive to US consumers and US goods become cheaper to the rest of the world. So just watching those investment flows and the implications from the pretty big currency moves that we're seeing in 2025. And the other thing is, of course, the Japanese yen is seeing a lot more demand in terms of that safe haven play, given the moves that we've seen in the US currency this year.
Okay, and so tie it up in a bow for us, please, Julia. What shall an investor do in this environment? Falling rates, stimulus coming through in China. Let's talk Aussie investors. Longer term yields rising and showing a few signs of cracks in the economic outlook and the ability of, those in policymakers to deal with that. So what do we do?
I think when we have a look at positioning, it's been a really turbulent and an interesting year, because when we have a look at volatility, which has increased and now it's back down to pretty normal levels, what you do see is volatility usually increasing times of a cyclical correction where the economy is starting to weaken off, or a structural correction where we're seeing, something like the tech sector being overweighted and then coming back down, as we did in the tech boom and crash. But this one has really been quite event driven out of the US. So it is harder to predict, but given that we are seeing rates starting to come down and inflation also starting to come down, what we are seeing is some of those inflation sensitive areas very much in the spotlight. One area that has been outperforming in 2025 compared to general equity markets is some of those inflation sensitive areas like infrastructure. And of course, in today's market, we've seen the property sector also coming back to the fore as well. So watching that infrastructure as well as that property theme. And of course, if we do see volatility spiking again, you'll probably see some move back into longer dated bonds as well. So an interesting year. For the time being, volatility has come back to normal rates, but really because this volatility is being event driven rather than cyclically or structurally driven, just watching those headlines coming out from overseas.
Got it. Julia, it's a pleasure to have you wrap the day with us. Really appreciate your time.
Pleasure to chat. Thanks, Nadine.
Julia Lee from FTSE Russell there. And back to equities, the stock of the day was TechnologyOne. Rudy Philippek Van Dyke from FN Arena, and we had Philip Pepe from Shaw and Partners. Now you know that this is one of Rudy's favorite stocks. Let's take a listen.
Management is expecting an acceleration in growth for the years ahead. Put that through your models, and for companies like TechnologyOne, that means that the valuation sometimes really jumps higher. That's why you see quite a meaty response in the share price on the day of release, which you normally don't see that often. And this is why those stocks seemingly always trade on elevated expectations, on elevated multiples. This stock is worth what it is, and is worth holding in your portfolio.
73 times PE, 1% dividend yield. What's not to like? It's a great bottom draw stock that if you waited for it to look cheap, it's like waiting for Sydney property prices to look cheap. Yeah. You're just going to keep missing out. I just can't bring myself to call it a buy. I would buy on a dip, but it is a genuine hold, bottom draw. Rudy will call you and say, take profits, ignore him. Just keep it in the bottom draw, and I'll call it a long-term hold.
That was the verdict on TechnologyOne, so a solid hold from both of my guests. Let's take a look, though, at what led the market higher today and look no further than TNE, up by close to 12% to $36.90. Okay, so clarity. It's up one day, it's down the next. Today, it is looking good. It says that its Amplify trial has begun, up by 5% to $2.29. South 32 also looking good, up by 4.4%. It is talking about export sales increasing from its Gemco wharf. So it's the first shipment of manganese ore being loaded as we speak. Domino's up by 4.4%, and Generation Development up by 3.1% to $5.30. 3. Let's flip the page, and we've got ResMed. So we mentioned it earlier, one of its rivals, I suppose, having some positive results, and that's weighed on its share price. PolyNovo as well is lower. Bellevue Gold, NRW Holdings, and PEXA down to $12.33, a loss of about 2%. When we get into the small cap, take a look at Dateline Resources. Don't know what happened there, but something did, up by 45%. Small stock though, so those percentage moves can be quite exaggerated. And GreenX Metals at the bottom of the screen, up by 9% to 82 cents. OFX shedding a pretty punchy 33, close to 34%. So it's come out with an update and putting out its FY25 results, clearly disappointing the market. That downgrade coming from Monash IVF, and Coronado has been in a whole heap of bother lately, down by 12% to 15 cents per share. So it was a big day here, wasn't it, with the RBA? It's going to be a big night. We've got the ECB Financial Stability Review. We get a late read on the leading index from the Melbourne Institute. In earnings, I think it'll be really interesting to see what's happening at Home Depot. And we have more Fed speak with Daly and Hammock speaking, those FOMC members. We do tomorrow get a monthly employee earnings indicator. It's expected to be 5.7% higher from a year ago. Trade balance in New Zealand, and we get some quarterlies as well. We get James Hardy, and we have updates coming from New Farm, Seek, and SGH as well. There you go. There is a final look at this market. Pretty picture to be seen for the COB Australia Index, up by 0.7, close to 0.8%. The S&P ASX 200 also finishing positive. Not quite as positive, up by 0.6%, pretty much, to 8,343. We will be looking for any news coming in relation to Ukraine and Russia. We are dealing with some political fallout here in Australia as well, with the coalition splitting after the election loss between the Nationals and the Liberals. That's pretty big. I haven't had a lot of time today to read deeply into it, but we'll be doing. And again, we had that stimulus coming from China today. So all in all, we hope you had a really great day, and we hope that we'll see you again tomorrow. In the meantime, have a great evening.